Because the regulatory regime, even though we know it's more friendly, we still don't know necessarily where things are quite going to land yet. We're still in a bit of a gray area.
Yeah, I think it's pretty funny that they can't interface directly on chain, so they go to an OTC or our market maker desk and pay a little extra.
But this acts as a good way for not only discoverability, but also breaking down the barriers and making it simpler for people to go ahead and actually use it then.
Welcome back to the Rollup. We are your hosts. I'm Andy.
I'm Robbie, and this is your home to learn from the biggest guests, the brightest minds at the tip of innovation.
Our goal is to help spread the collective knowledge of everyone in our community.
We are breaking crypto out of its echo chamber and taking it to the real world.
All right, Corey, we're in New York City. Thanks for coming by. Interesting days in the markets, that's for sure. In DeFi?
Always the case.
Yeah.
Always something going on.
So you got into DeFi quite early then, 2018, 2019?
Yeah, my formal entry in crypto professionally was in late 2017, early 2018. And my entry was actually in 2015. It's a fun story I'll just start with. But at that time, I was very into game modding and exploitation. And one of the games that I was hacking, the company shut me down on PayPal. So I started taking Bitcoin for payment then back in 2015 or so. And as I say at that point, the rest is history. Just get your feet wet with the industry and then you just never find a way to leave.
Yeah, man. I mean, so we were originally DeFi slave back in 2019, 2020. That's when we started doing media, and we were basically covering the frontier of DeFi and of the original Uniswaps and compounds and yield farming. And we did that for about a good 2 years. And in the bear market of 22, we actually shifted to, this is when we rebranded to be the Rollup, as we saw the infrastructure movement really kind of pick up. We saw a lot of actual new chains and new we realized that this is where the puck was going, and also a lot of the reason that the 2020 and 2021 cycle kind of dwindled out was because we couldn't support all the demand. Then we got Solana, we got L2s, different L1s. But it does feel like DeFi is making a roaring comeback now with the institutional push, with stablecoins, and with this current revenue buybacks, etc. meta. So I've seen it kind of come full circle, but I'm not sure we see the DeFi that we saw back in 2020 for a while unless we get lower rates.
I think the market's also a bit all the wiser at the same time. But to your point, we're seeing a lot of value recycled back to the application layer. Beforehand, people were very interested in investing in the picks and shovels, the stuff that would be considered base infrastructure. And I think apps weren't quite as sexy, if you will, for a while, but we're seeing that come full circle with things like Hype, 𝗷𝗍 initiating buybacks, some of these really good applications that have strong product market fit, making a strong resurgence and really establishing plenty of flag in the ground, if you will.
Yeah. I mean, I remember Arbitrum has kind of notably been that DeFi L2, and that's where Dolomite had originally gotten its flag in the ground, and then since then we've just seen a lot of new chains and new places for DeFi. What would you say is your current take on the state of DeFi as it is multi-chain and as it is across the entire landscape? Where are you seeing, just broadly, what's your kind of state of the DeFi?
I think we're seeing specialization, if you will, on certain chains, the same way that Uber didn't necessarily roll out the same way to each locality where it would be stood up with this application. DeFi, you have perps, you have lending, you have dexes for swapping, but there's a certain culture that gets instilled on each chain where you really start to see product market fit take off. Arbitrum to me feels like the canonical ETH L2, if you will. You want ETH but faster, you go to Arbitrum as of right now. And you got some of the things that make it unique, like GMX, of course. You have really good liquidity through 𝗷𝗍. You have other applications that are bridging off from there, like Hyperliquid, that are very in close in proximity, so that's all great. Go over to things like Solana, of course, you have the meme coin culture and a lot of the fast degen swapping going on. And I think that if other chains want to be successful as it pertains to DeFi, because I still think that DeFi is one of the best use cases just for crypto overall and smart contracts, that there needs to be some kind of niche thing or center of gravity, if you will, for each of these chains to be successful and actually have staying power over time.
Innovating finance, global, institutional, and on-chain. Deep liquidity to drive capital efficiency. Now, maximize yield on institutional-grade liquid staking with 𝗵𝗶𝗶𝗵. Unlock $1 trillion of capital via 𝗵𝗶𝗶𝗵. All of this secured by Mantle's treasury of billions in stables and ETH capital pools. This entire ecosystem is coordinated by a vast network of seasoned VCs that are aiming to create the next generation of banking and financial technology. This is Mantle.
Yeah. And I mean, I think we've seen the rise of now, obviously with like things like Unichain, where there's these DeFi applications that are trying to like own their stack as well. Do you think that's a general trend that will continue, or do you think that composability is kind of more important than owning your own block space?
I'm definitely more of a composability maxi. I think that those use cases of trying to own your entire vertical is very tough unless you do have like a really large user base to point people to and can just basically like route user flow from what would have been Ethereum mainnet or Arbitrum and point it to your own stack instead. But it's going to be a challenge for them otherwise. And like I think about this a lot for a platform like Dolomite, like it's a money market protocol. Our utility is always being very close to the ground of where the action is, because when you're using a platform like whether it's Dolomite or it's Aave, the value you get from it comes from the ability to swap and use those spot assets wherever the best opportunities are. So if you're using Aave on Arbitrum, you're probably using it on Arbitrum for a reason, considering Aave is also on other venues. You could use it on other networks also. And then when you move these things instead to your own stack, your own vertical, you're losing whatever things were happening that were in close proximity before to it at that point. And this has really large implications for money market protocols in particular because of risk management and how you underwrite for these assets. Considering most liquidations and all the actions you do, they tend to happen within one transaction, or as we say, atomically. But as soon as you move to your own vertical, unless you can replicate all those network effects and liquidity, you lose all that really cool functionality then, and you're back to this world of having to figure out how to bridge back and forth easily, and do like manual looping processes, which is one of the main use cases for money markets. And you just go down this rabbit hole of like all these new user experience issues that come up that you don't appreciate were fixed because you move to your own stack, to your own chain that might have been faster or cheaper. It's like there is give and take with it.
Yeah. No, there's definitely a trade-off, and I think we've seen teams make different trade-offs in their designs based on kind of like what they want to achieve. And we had that era, right, where we had a Uniswap on one chain, then we had SushiSwap, and then it went onto tons of different chains, and then Uniswap kind of slowly kind of followed. But then we kind of, I feel like, returned back to like this native application ecosystem for a given chain. You guys have recently, you guys have been on Arbitrum, but then have also launched on Berachain. What was the thought process behind that? And how has that been as a builder, how has it been launching on different chain and now kind of maintaining two instances?
So for us and our team, like we're pretty small and tactical. We aren't as agile as other teams are, where we can just deploy everywhere and service it with the same level of quality like that Aave could, for example. But where our specialty comes into play is by like rolling up our sleeves and doing like some cool white glove integrations that makes Dolomite unique on the chain that it's on. On Arbitrum, we integrated with the GMX V2 assets. We originally did stuff with GLP, with the GMX token itself for staking it. We did stuff with the ARB token where you could still vote with it while holding it on the platform, which opened up leveraged voting. And the point is that we did the really cool stuff that centered around what makes Arbitrum great. Stuff with GMX, ARB governance, which was one of the most active DAOs in the entire industry. We wanted to do stuff that we thought could deliver value back to the real users of the chain, not necessarily the people that were just there farming it. And then if you switch chains then to Berachain, for example, and still use Dolomite, you'll recognize all the same great features we have for managing your portfolio, managing multiple borrow positions, and the stuff that you'd come to expect from like a top tier money market platform. But the way that you'd use Dolomite on an Arbitrum versus Berachain might be very different. Because of the assets we list, or for Dolomite in particular, one of our unique features is what we call dynamic collateral. It lets you rehypothecate your collateral assets into specific DeFi opportunities in order to scrape more yield or tap into other opportunities you might usually lose when you use other money market platforms. So what we wanted to do is, like I said, be tactical, really focus on specializing in key markets where we thought we could drive value because of the special things that our tech stack can do that others can't, and be able to shine because of it. Hopefully offer something that others can't or is significantly worse, to the point where we can specialize.
Yeah. And I mean, I think Berachain's in an interesting spot, right? After 𝗵𝗵𝗴𝗵, what do you think is the future of Berachain going forward?
I think the future of Berachain is got to be proof of liquidity. Like, 𝗵𝗵𝗴𝗵 in general was like a launch pad to be able to, or a springboard, if you will, to drive liquidity through and be able to kickstart the flywheel. Because otherwise, it's a pain to start off with like very little liquidity. You know, your risk caps for underwriting are then like really low, and you're going through like this iterative process to build it up. You know, 𝗵𝗵𝗴𝗵 was able to springboard into what is now a multi-billion-dollar TVL chain right out of the gates then, which was really exciting for not just Dolomite, but other native applications that were able to participate in 𝗵𝗵𝗴𝗵. And now at this point, the bribes are flowing, proof of liquidity is working. There's still a lot of confusion around how proof of liquidity works and the complexity around it. But the really cool thing, at least when it comes to like Dolomite and how we try to position proof of liquidity on chain, is to us, it's just a staking contract. You know, staking as it pertains to DeFi has been around for years now. People understand it. They know that when you stake an asset, that asset's not going away. You're not going to lose it to an impermanent loss and whatever. All you're doing is you're doing that to get rewards.
Yeah.
And we just released these things called POL tokens on Dolomite, where, as the name suggests, you're able to essentially stake the assets in proof of liquidity, get the rewards with it, but then you can actually borrow against it and do other cool stuff on Dolomite with it at the same time. So proof of liquidity is now just one click away from our platform. And one of the things that we've noticed with Dolomite on Arbitrum, and now it's being brought over into Berachain, is that because we have so many assets integrated and all these cool opportunities that stay within Dolomite, you can get exposure to some of the best things happening on chain without ever leaving our site. And we do that in such a way where not only you get to see it, but we have descriptions on there where you can actually see the assets, get breakdowns of what they are. We'll link out to where the asset itself is being issued. So if you want to get direct link to the site and learn more about it, you can. But this acts as a good way for not only discoverability, but also breaking down the barriers of making it simpler for people to go ahead and actually use it then. Yeah.
I think that kind of issue of actually making things easy for users has been a problem for a lot of protocols. But the thing is, I feel like on Berachain, you're kind of adhering to people that are much more on-chain native, which kind of, I think, a little bit of complexity, degen yield farmers are kind of used to. But at the end of the day, you can see things. The easier that you make things, the less clicks, the less hops, the better, right? And so.
Yeah, I think one of the biggest issues in DeFi isn't even necessarily just the complexity. It's also the discoverability. Like the idea that, take a simple example, if we roll out like a new portfolio management feature on Dolomite, we'll put our announcement out on Twitter about it, but if you happen to miss that and you come to our site like a month later, you might not necessarily know that it exists or know that we have that asset listed in anything like that unless you go looking for it. And with so many things happening in DeFi nowadays, it's not like the early days in 2020 where there's only a couple protocols to track and every announcement would ring around and like bounce around the walls for a while before it like finally simmer down and you lose track of it. Now we're in a world where like everyone is competing for attention. You have not just applications, but tons of chains also competing for that same attention. You have tons of abstractions in place now where wallets might try to make the user experience easier, which might abstract away some features on your site. And it's a much tougher process now to understand what the best way to roll things out to users is. And even beyond that, just the fact that you're competing for attention at the same time just makes it so much tougher.
Yeah. Introducing Asset Runes, the future of decentralized finance. Stablecoins natively on Bitcoin. Hedge against volatility. Diversify your portfolio. All directly from your Bitcoin wallet. Secured by ZK technology. This is Asset Runes. Available now, exclusively on Starknet.
Yeah, I mean, I think one thing that you guys have pulled from that era has been the VE model. have you guys made any special changes to the VE model or anything in particular that you saw flawed in the original curve model?
So we made like what we think were like next generation enhancements to it, but wanted to also respect its initial vision. Most notably, the lock time was changed from 4 years down to 2 because 4 just feels like an eternity in our industry. We did add the ability for you to break the locks early for a penalty. The penalty you pay decays over time as the lock gets closer to maturity. What happens with the penalty that you pay also is pretty interesting in that some portion of it is burned. Some portion of it is put into like essentially a buyback fund that can be used for other parts of our liquidity mining process. But also like when you look at the VE model, it works really well for DEXs where you're dealing in the permissionless world. But as you venture into most money market models, there's at least some degree of permissioned or a lot of permissioning that's happening. Dolomite works more like Aave, where there's a lot of permissioning and curation that happens compared to some of the more permissionless and isolated venues that are out there. And so like because of that, like there isn't quite the same need for gauges that you might otherwise see in like a purely permissionless venue. And so with that, like what we're actually doing a little bit differently is with our VE token, instead of like doing strict revenue or passing through bribes that might occur, which we still could experiment with later. Instead, what we're doing is actually fee rebates for your borrows depending on how much you VE lock. So the basic formula for it is if you have $5 of VE Dolo, which is of course time weighted, so that means if you're max time locked, you're eligible to get $1 back in fee rebates for every for all the borrowing activity you do on Dolomite then. And so this gives people that want to not just go along the platform and our potential growth, but also want to get kickbacks at the same time and have edge over other borrowers, gives them a reason to hold our token and lock it for the medium to long term then too. And I think it's a really interesting idea because, at this point the market's, like we said in the beginning, a bit wiser now of how they'll play DeFi, how they'll value products. And so I think like when you start to turn on like revenue kickbacks to users, like what ends up happening is like the market knows how to value your token. There's a bit of a glass ceiling in place. And considering we're still like on the smaller side, we're still like what I consider to be like a fast growing startup, relatively speaking. We thought the best approach instead was to still put a flywheel in place where like our growth could line up with value accrual back to the token, but instead in the form of fees instead. And the nice thing is that these people that we'll be locking are probably a different demographic than the pure value players that are just going to go buy the token because they think it's like below some PE ratio instead. Mm-hmm. There's a bit more of a flywheel to tap into there with it.
Yeah, I feel like the market has gotten a little bit exhausted of the flywheels personally. And as you said, it has wisened up. That being said, I think where the market is kind of trending towards is this form of redistributing value back to the token either way, fees, revenue, burns, etc. Curve and some of the original DeFi companies had this model back in 2020, 21, but for some reason that entire idea has grown another set of legs over the last 6 months. I tend to think it's partially because of Trump's presidency and being now a bit more of a deregulated state of affairs. But I'm just curious, like from interacting with other DeFi founders and builders, what is the kind of state of affairs when it comes to, okay, we want to distribute revenue, we want to build like actual flywheels that make sense long term. Like is there a bit more of a sustainability approach now? Is there a bit more of a thought process towards like a longer time frame? Kind of like how are you seeing that amongst your partners and team?
I think there's two parts to it. I think you touched on the first part already. Like I think as soon as Trump got elected, there was an immediate vibe shift where people were much more relieved over the incoming changes to like the regulatory regime. There was obviously a lot of crypto founders, companies, users, team members, etc., that were all very worried about, what another 4 years of a similar Biden-like regime could do to our industry. And so that was an immediate tone shift, and we saw, things like applications start to open up users to the U.S. We saw Coinbase and others start to list new assets or relist assets that were otherwise taken off the platform. And we also saw like even simple things like conferences and stuff start to be hosted in the U.S. or change location to be back in the U.S. again, which was cool. So that's the first thing. The second thing is, of course, because of those regulatory things, I'm of the mindset that it's also what paved the way a bit for the meme coin super cycle that we just went through. And a lot of people have gotten very tired of the idea that you have all these platform governance tokens, whether it's Uniswaps, Aves, or others, and they didn't have value accrual mechanisms actually going back to the token, at least not yet. And people were like, these are no better than memes right now, or we're going to call them financial memes. So I think it was a bit of like exhaustion of, we have all these revenues coming in, we have these fees, like let's direct these back towards the token and prove that we're not just some meme or some financial meme. Mix that with good timing of the Trump presidency, and you have some fireworks now where there's some new excitement injected back into DeFi because there's tangible things happening and meaningful differentiation now of how these projects are functioning compared to a traditional meme coin.
Yeah, definitely. Yeah, I mean, I think that that's been a large shift in the entire space. But the biggest one has been institutions and the desire for this new capital to come into tokenization, to DeFi, to stablecoins, which I do feel like there's already started to be some winners in this category while others are kind of lagging behind. What would you say is your institutional strategy, or what would you say would be some good advice to people that are trying to build out an institutional DeFi strategy?
I think that you need to be flexible and remain very modular with your tech stack and your approach. Because the regulatory regime, like even though we know it's more friendly, we still don't know necessarily where things are quite going to land yet. We're still in a bit of a gray area, but we know it's trending in the right direction. So depending on where that might go, you might need to change your tech stack accordingly, launch new instances, put a sandbox out there. Otherwise, have something that's flexible enough to meet the needs of these institutions as they're entering our industry and looking to compose around what is already existing in DeFi. Now, the challenge with that is, like, depending on how you might take that approach, you might lose one of your biggest moats out there, which is your liquidity. One of the best things going for Aave is not necessarily just its name and its reputation as being number one, but the liquidity that comes around with being number one. We saw a lot of the centralized lending desks go down after the bear market of 2022, and a lot of that recycled back into Aave at this point, considering that centralized lending has not come back in the same way. So a lot of institutional usage hasn't even necessarily hit only in the form of asset issuance with BlackRock's build fund or stablecoins being issued, but it's also come in the form of using some of the biggest players out there that have good reputations, that have the liquidity to meet these institutions' needs, and start tapping into it. I've already seen instances behind the scenes where, like, certain market makers, if you want to go hit their lending desk, they're really just quoting off of Aave plus some spread. And because some institutions just can't go bare metal, if you will, and go on chain to where the lowest point in the tech stack would be, they're instead hitting these market makers, these desks instead beforehand as a bit of a buffer. And so that's what's really interesting with, I think, how these DeFi protocols are evolving, is that we've taken the approach with Dolomite where we think our battles are best won over the course of months and years and not days and weeks, compared to other projects, how they might situate themselves. And so for us, if we can curate enough liquidity and trust over time, that we think we can really service some of these use cases and needs really well as you build these connections, as you build these relationships with these institutions. And that's how you win that game over time as well, if you can meet those needs.
Yeah, I think it's pretty funny that they can't interface directly on chain, so they go to an OTC or market maker desk and pay a little extra.
I mean, we laugh about it because we can recognize it for how silly it is, but think about some of the regional banks that can't necessarily access the Fed the same way that some of the big ones can.
Yeah.
And it's, you can look at it similarly through that scope, and I think that's the analogy I choose to look at it through. So
Yeah, makes sense. So when you're looking at your current set of liquidity and users, what is it about Dolomite that people are particularly using it for? And kind of what feature set do you want to keep iterating on to be able to build a more extensive product suite?
So I think I alluded to this a little bit earlier, but I think people really come to us because of the unique assets that we have listed and our ability to underwrite for them pretty aggressively. Going back to the Arbitrum example, again, we have the GMX V2 assets. They're called GM pools. They're very classic counterparty vaults where they underwrite for perp trading. So if traders net lose, the counterparty vaults do really well. traders net win, they don't. But they also get paid fees and other things to it as well. These assets are really good assets for looping, where like if you have a GM ETH asset, you could borrow ETH and loop into that. And notwithstanding the open interest skew of traders winning and losing, you have an asset that's very tightly correlated with ETH that you can get amplified ETH yield exposure to. And so what we've seen is like on Dolomite, on Arbitrum as the example once again, we have a bit of an interest rate premium where people are willing to borrow for a higher rate than what Aave is charging because of the feature set we have on there. And it's not just because of the assets, it's also because of the features. We're trying to transcend lending over time and become a bit of a hybrid DEX, but also a prime brokerage as well, where you have access to really good portfolio management functionalities and things that if you just went elsewhere, you have to like either lose the functionality altogether, or you go back to the classic situation of like you use Aave, but then you swap through an aggregator, you use DeFi Saver at the same time for managing your positions, then you're also hitting DBank up for watching your portfolio. It's a bit of a mess. So we're trying to consolidate that and offer a lot of functionality where like you're losing value by jumping off platform. Going over to Berachain then, those POL tokens and integrating around proof and liquidity for that staking is a very key point for us to integrate around, because that's where all the yield is sourced from. So the more that we can underwrite for that efficiently, the more yield that our users can make, the more that we make as a protocol then, because we make most of our fees from people borrowing and taking skim off of that. So that's the name of the game. And so like we think that the evolution for Dolomite really revolves around us being able to increase that efficiency while also trying to drive down borrow costs as much as we can and increasing supply side yield. So we have some things that we're cooking up there that I think will be pretty exciting over time. And one of the things in particular is our own take on smart debt and smart collateral, which is obviously inspired by Fluid because they're one of the category leaders in it. We have something really cool being built out there that's more akin to like an RFQ-like approach, request for quote, as compared to them where they built out the AMM instead for that feature. So some really cool stuff there.
Very interesting. Because I think that a trend that we're seeing is like this idea of super apps where you actually have, so you look at your product suite and you're like, okay, we have one or two core things that are working. This is where we're getting a lot of our users. Why are they leaving the app? They're leaving the app to go, I don't know, not swap in this case, but maybe do something else. So, okay, well then how can we build that feature out so that way they don't need to leave the app to do it? Or you just keep iterating on this question of like, why would somebody leave? Okay, let's just build a thing that they don't want to leave for, or that they would leave for.
Yeah, I think one of the biggest reasons that people leave our platform is usually because of lack of liquidity. Like, if there's a supply crunch where like a big lender has to pull out funds and rates get squeezed upward, like, that's challenging and it can lead to people having a pretty poor borrowing experience and have to go elsewhere then. But generally speaking, like we have a pretty sticky user base that once they like find their feature set, find their strategy, find their comfort in our platform, it's always to some extent, at least in their toolkit, ready to be used.
Yeah, makes sense. So what is the multi-year vision then here of Dolomite as we kind of look ahead with the current regime? What is your key kind of KPIs or metrics, like one or two things that you're really trying to optimize for and why?
Yeah, we're always trying to grow our total value borrowed and the amount of volume that flows to the platform, and then volume in this case is measuring people that are swapping. Because that usually means that people are using some of the portfolio management tools that exist within the platform and are then therefore also staying within platform without going elsewhere. So like for us, the things that we're focusing on doing to increase those KPIs revolve around integrations with large applications and venues that have access to large user bases and being able to plug those into Dolomite. So that can mean anything from alternative front ends to some of those desks that we were talking about, always trying to expand our reach that way. And the other thing too, which I just mentioned, is trying to squeeze more efficiency out of the platform. I think one of my controversial takes on the money market space, or sub-segment of DeFi, if you will, over time, is that in order to remain successful, unless you're Aave and you have that liquidity moat and you have that Lindy effect of being number one, the only way that you're going to survive over a meaningful amount of time is by offering some new efficiencies that others really can't tap into. I think that Fluid has done a great job of that. And we're looking to carve out our own similar niche too, through not just the asset listings, but also as I mentioned too, like our smart debt feature that we want to roll out as well.
Beautiful. Corey, kind of as we come to a close, when you're looking at the DeFi landscape today, I think I'm not exactly sure the TV. I know stablecoins is around like 250 billion. I think we'll end up having, trillions on chain. Where do you think we go from here more broadly as an industry? Where is this capital coming from? How do we get to multiple trillions on chain?
Well, if we're talking trillions and not necessarily just billions, it can't necessarily come anymore from like, Robinhood or some other fintech application plugging in their user base into DeFi. Like that's not necessarily enough at that point. Instead, it's probably going to come from, as boring as it may sound, some bill that gets passed over in the government that's able to essentially turn that gray area into a white one, where all of a sudden the big capital that's able to make very large Titanic-like shifts into the industry can go ahead and start doing so then.
Yeah.
They're not very fast to move, but when they do, they swing hard, as we all know. And I think that's what will end up happening in order to bring it on chain. And I think our collective hope is that when it does happen, it's coming into the pipes that we're all familiar with, like the Aaves or the Dolomites of the world, coming onto Ethereum and other public blockchains at that point, and not necessarily in private ones or anything like that.
Yeah, man. I think we are going to get to trillions. I think stablecoins are going to be a big part of it. It's just a matter of getting those assets on chain onto public blockchains, as you said. That's like the most important. Congrats on launching your recent token as well. I know that's a lot of work. Are you feeling good about it? Are you feeling all right?
Yeah, feeling really good about it.
Good.
I would definitely not want to launch a token again. Not because I don't think the launch went well or not went well or anything like that, but just because the process is very stressful nowadays.
Yeah.
I've been in the industry long enough where through the ICO mania and everything in between, to see like how easy it was to launch a token, then how much people didn't want anyone to launch a token because they're like, these are useless, to, oh my God, tokens are great again during DeFi summer.
Yeah.
And now the process involved with it, because there's so much, as we keep talking about before, you're fighting over attention.
Yeah.
And, because of that, it's like tough to get exchange listings. It's tough to get people to care about it. It's tough to differentiate like why your token needs to exist in the first place. And all that just culminates into like an uphill battle to get it out there and do it what I feel is, and what our team felt was the right way to do it.
Yeah.
So, we think we're on the right path, because at the end of the day, like our platform doing well is the North Star metric that we could use to some extent or to a large extent to plug back into the token. And so as long as we keep iterating on Dolomite and seeing product market fit take off, that's the most important thing.
Well, Corey, I appreciate you coming out, man, and your time. And congrats on the success of Dolomite. Been a user since probably 22. I may have deposited first, 23 on ARB. So it's been good to see you guys stick around and grow and now launch. And the best is yet to come.
Thank you so much.
Thank you, sir.